Over the past few years, many people have fallen in love with dividend investing. Dividends are seen as a source of true passive income and a way to snowball onwards to financial freedom. And what a load of horseshit. These investors are making an amateur mistake that's going to cost them an utter fortune in the future. In this video, I want to get away from the noise and nonsense that you see online on Twitter and on YouTube that say dividends are the best thing since Kanye and Kim. Because simply put, they're just not. In fact, in many cases, dividends are actually bad for investors. Now, before we get into the 4 big reasons why dividends are actually bad for us, we must first understand what investing into a dividend stock or ETF actually means, because even many people are messing this up. When you are buying an equity or a stock, you are entitled to a share of that future cash flow. As small as it may be, your single stock is a slice of ownership in that business. You are rightfully entitled to any future profits it makes and are impacted accordingly to the decisions that the management team in that business is going to make. And I think that in itself subconsciously is one of the reasons why many people actually love the thought of getting a dividend, because it's some way of getting cash out early in case management fucks up somehow. Which leads me on to issue number 1. Typically, when a company generates cash or profits from its operations, there are several things it can do with it. It can pay off debt, it can reinvest into new ideas or infrastructure that will hopefully generate even more cash flow in the future. It can buy back shares, which will increase the ownership you have in that company, or it can pay you a dividend. And if you fundamentally think about it, dividends is the worst of these options. Now, all of these options are good for shareholder impact and overall shareholder sentiment, because it means the company is actually positive in a cash sense from their operations, which in this market is hard to do. Simply put, you as a shareholder are rewarded in 2 ways. You can get a dividend or you can get a boost in stock price. Sometimes you get both and are lucky. But think about this. If a company you've put your money in, you've sided with, you've invested in, is prioritizing paying you a dividend, does it not show a form of lack of ambition from the management team in the future? I'm pretty sure many people don't invest their life savings into a stock just to get a measly 3 or 4% dividend. They of course want the stock to go up in value too. We select these companies, we invest in these businesses on how they are at generating new cash flow and how they grow themselves as a business. We want the highest possible return. For example, if we look at one of my biggest holdings, Meta, it recently started paying a dividend and I wasn't too happy. Meta's return on invested capital, its ROIC, is about 35%, meaning it generates about $35 in cash flow for every $100 it invests. Now, if Meta pays me a dividend, let's call it a flat $100, I myself cannot make up 35% return on that dividend. In fact, what I actually want is Meta to manage my money correctly and get me the best return I can possibly get passively. And that means retaining the money I've actually put in the business. If I wanted something back, I'd sell some shares. A company like Meta paying me back shows that they have too much cash on hand compared to their projects and future ambitions. It's not a bad situation at all, but it's definitely not the best situation. I'd rather them keep my money because of the next point I'm going to come to in a second. But first, if we look at the dividend aristocrats like Exxon or Coca-Cola, they also have a lower return on invested capital, usually around 10% or below. Have these companies just ran out of ideas of ways to aggressively expand and innovate? So again, it comes back to, do you want dividends or do you want the best overall return? In which case, overall return should win and you shouldn't care about a dividend. Now, of course, I could reinvest my Meta dividend back into the company, but that brings me on to the next big issue, which is tax. Tax is a silent killer nobody is willing to admit within dividend investing. When you get a dividend, it is taxed. Regardless of what you see on Twitter or what you see because of some magical account, it is always taxed at some point. Sometimes it's only once, sometimes it's twice, and sometimes it can be multiple times. You can protect yourself with some limits in things like a Roth IRA, but even with your investment being in a tax-efficient model, that dividend has still been taxed at the corporate and company level, meaning the money you were already entitled to as a shareholder has been paid out from the company after tax has been paid to Uncle Sam. To simplify the mathematics, and we can get nerdy on write-offs and things like that, the corporate tax rate in the US is about 21%. If you receive $1 in dividends from a company, it would actually be $1.21 if they kept it within the business and found a better use for it within its own operation. So as a shareholder, which one would you prefer? $1 or $1.21? When a business pays you out, it is taking an asset out of the business to give to you. It's good for shareholders, but not necessarily good for the overall market cap of the company. That's why so many companies screw up on dividend payments. Now, aside from corporate tax, there are still some other tax issues we have to talk about. Many investors think just because they have a Roth IRA account, there is no tax and they can just live their life happily ever after. And it's a huge misconception, especially with this whole dividend and passive income movement. Because if you wanted passive income and dividend income, a Roth IRA doesn't really shield you unless you're willing to lock away your funds until you're 59 and a half years old. In which case, what is the point in having passive income and a fucking dividend if you can't touch it? It defies the whole passive income argument completely. And that brings me on to my third point, which is human emotion. People love dividends. I get it. Me too. You get a bit of dopamine when you get that notification on your iPhone that you got $1.16 from a Coca-Cola dividend. It's like getting a match on Tinder. She looks an 8 online, but if you look beneath the surface in the real world, she's a messed up psychopath who really wants to hurt you. The reality is this dividend dopamine is killing your returns because of your human emotions. Humans want to see something back in exchange right away, especially when we make a purchase or investment. Think about it. You order something on Amazon, you instantly want to know when it's delivered. The day you sign up to Netflix, you're going to watch something pretty much right away. You don't sign up and then wait a couple of days. And that is why so many investors fall into this whole dividend passive income trap, chasing little gains rather than focus on the true compounding effect that can happen within a business. What these dividend experts on Twitter and YouTube do not tell you is that in almost every case, dividend aristocrats and dividend ETFs just underperform the overall market. So unless you need this passive income to survive, by which I mean you're in retirement, you really don't need to be focusing on dividend investing at all. You should just buy a total market ETF that gives you the best return for the least amount of effort. If we just compare the Schwab's SCHD, which is one of the most famous dividend ETFs, to Vanguard's S&P 500 VU, we can see that the total market is getting a better return overall. In fact, it's nearly 1.5% per year extra in returns, and that's every single year. This extra return compounded over a long enough period will substantially increase your net worth, but it will also dictate when you can actually enjoy your wealth and retire. To put it an even more simple way, I can name you many iconic investors who've built their wealth buying stocks and letting them compound on themselves over time. Warren Buffett, Charlie Munger, Michael Burry, Peter Lynch. The list is seemingly endless, but I cannot name you one billionaire investor who can stand toe-to-toe with these titans who made their money slowly, investing focused on just dividend passive income. So if that's the case, my question to you is why you focused on dividend stocks and dividend ETFs. If you're not at retirement yet, it's all about contributions and how much returns you can actually get year over year. So why focus on dividends? Because believe it or not, there is even an ETF or two out there that dominate the overall market. In fact, their returns are nearly double that every year of the Schwab's SCHD. So watch this video next if you want to increase your returns and get a more stable financial future.